What if you could grow your investments in a whole different way using dividends? I was recently thinking about a dividend waterfall strategy, and it could be quite interesting and yes, even lucrative. The theory is we take our investments earned from one fund and reinvest them into a whole different fund. Now, you most likely have heard of DRIP before, Dividend Reinvestment Plan, and that's taking the dividends earned and reinvesting it back into the same company, back into the same stock. But we're going to flip that on its head. Instead of doing that, we waterfall it. We take those dividends and we buy a whole different company, a whole different stock with it. Could that help? Could that be something interesting? Could that be a bad idea? Now, for fun, I'm going to select 2 funds. Just for fun, but you can choose whatever you want. You can do these calculations on your own if you want after this video. I'm going to start with Realty Income Corp, ticker symbol O, very famous dividend stock. It's a REIT, everybody talks about it. And right here you can see on the dividend tracker, has a very relatively good dividend score, market cap of 40.14 billion, blah, blah, blah. Most important part is the dividend paid. So we can see that the dividend yields at 5.01% with a dividend growth over the last 5 years of 3.1. Let's say we decide we want to buy into Realty Income. Now, if I come over here to the dividends tab, I can see that our annual income is at $3.06, and down here we can see all the different distributions. O distributes dividends every single month. So based on what we see here, for example, the very last one, as of the recording of this video, was 26 cents per share. And that's actually gone up. So we can see before it was 25 cents. Back here it was at 23 cents per share. It continues to go up. Why not take a monthly paying stock and take that and invest it in a monthly paying ETF? And I'm going to choose another famous one that's talked a lot about in the dividend community, and that is JEPI. First things first, I'm going to buy 500 shares of ticker symbol O. Why 500 shares? Why not? And plus, I'll get like $1,000 in dividend payouts every year as a result. I think it's like $1,500. So we'll take that $1,500 and then we can invest it into JEPI. Now, what I've done to make things a little bit easier on myself is I plugged it into Excel. So yeah, we're going to get a little nerdy in today's video, but not totally. I want to kind of make this easy to understand. Let me zoom in here and we'll get right to the point. So here we are at our 500 shares. Now, we're going to go back in time because we're not psychics. We can't see into the future. Although if you are, please drop a comment down below with what dividend stocks you think will do really good over the next year, because you're a psychic. You should know these things. But right here we are. So 500 shares at 23 cents back in July of 2020. We're going to scale this all the way up until April of 2023. Now, what you can see, how I have this split up, is this is the dividend paid by O, our amount of shares, which will remain at 500 because we're not going to buy any more. We dropped 500 shares and we're going to keep 500 shares and we're not reinvesting the dividends. So that's all it's going to remain. And then how much we earned each and every month. Then what we're going to do is we're going to plug that into JEPI. So, for example, back in July 2020, let's say we get paid 23 cents a share. All theory, but this is the point of the waterfall. So 23 cents times 500 shares is $115. So JEPI closed at $53.22. So taking my $115 earned from O, I'm going to waterfall that over into JEPI. And that means I'm going to get a total of 2.16 shares. Bought with O. It doesn't mean bought without. That means bought with O. So bought with my dividends from O, I get to get 2.16 shares of JEPI. Now, because I earn shares, I'm also going to get a dividend. So depending if you hit right before the ex-dividend date, you would get a total of 49 cents per share, which means I earned $1.06 from JEPI. So that's what's interesting about the strategy. Now, the math would say, are we actually going to get a better deal? Would it be wiser to drip in this case versus waterfall? Let's take a look. So all throughout this, all the way down here, I'm going to remove this little block here that I have. I'm going to move this over and we're going to see O and what we could have earned all throughout here. So we can see that throughout July of 2020, if I highlight this all the way down to April of 2023, right down here in the corner of Excel, it tells me my total. So that means we earned a total of $4,090. That's our total dividends earned throughout this time period that we're looking at. So that means I bought now, over this time, $4,090 worth of JEPI because of the waterfall method. Let's have a look. So each and every month, I'm buying shares. So now I got another 2.12. I got myself another 62 cents. We keep coming down the line here. So if I come and I highlight this all the way down, we're going to see our O waterfall bought us an additional 71.78 shares of JEPI. Is that we have 71.78 shares of JEPI as a result of the waterfall. And then we have a total of $4.93 of annual income. So split on all of those monthly dividends that JEPI pays, the total for the last 12 months gives us right around $4.93 per share. So what we're going to do is we're going to multiply these together. If we have 71.78 shares multiplied by $4.93, that gives us a total of $353.87. That's how much income we're going to generate thanks to the waterfall from O. But that doesn't answer the question, does it? The question would be, what makes more sense here? Do we take the dividends from O and reinvest it into JEPI, or do we just do the dividend reinvestment plan, the DRIP, the thing that everybody knows, the easy thing? Why don't we just do that? Let's calculate and see the difference. So if I come over here to O, we know that we generated a total 60.64 shares of O. Now, how I got that is right here. So right here, we have the close of business for 7181. Again, not exact math, but just for the demonstration that we're doing today. So if I had a total of $115 earned from my 500 shares at $60 a share on 7/1, that means I got an additional 1.92 shares of O that would be reinvested back into the company, which means back in August of 2020, I would then have 501.92 shares. Onward and onward it goes. In fact, the breakdown is right down below here. You see this? The dividend paid from O, my total shares, and the total earned. Then with the dividend reinvestment plan, it keeps going up, as well does the total earned. So if we come down here to the bottom, we can see that we generated an additional 60.64 shares during this period with the dividend reinvestment program. O right now pays a total of $3.06 in annual income. Now that would give us 60.64 times 3.06. That would give us a total of $185.56 per year with our DRIP. Do you already see the difference here? Look what happened. You're getting more. You're getting $353 with the waterfall method versus $185 with the DRIP method when we use O as an example. Now, what that means is that you're getting a total of $168.31 more with the dividend waterfall strategy. How interesting is that? Could that be an opportunity overall, when you look at the math holistically, zoomed out, to make some more money? But it's not all that easy, right? Like, that's a good example. O and JEPI, 2 monthly paying dividend investments. But what if we do something else with that? Somebody else mentioned, why don't I take JEPI and then waterfall that into SCHD, another one, another great ETF, one of my favorites. That's where things get a little bit sticky. See, we're talking about a high dividend yield on JEPI and a good dividend yield on SCHD. But see, JEPI is higher than SCHD, so it's always going to be favoring the higher dividend stock. So in the case of O to JEPI, that makes sense because JEPI has a higher dividend yield. But let's take a look at JEPI versus SCHD. Now, if we look at that, see what's happening here. I'm going to flip this around. Now we're going to buy 500 shares of JEPI straight off the bat. And now we have our dividends paid just like we did with O, our total amount earned, and how much we would have reinvested back in with JEPI every month. So we would have got an additional 4.6 shares in July, 2.6 in August, so on and so forth. But then what we're going to do instead is we're going to waterfall that $245 or $145 or $225 into SCHD and leave 500 shares only into JEPI. So we come over here to SCHD, you can see what kind of happens here. Now, SCHD does not pay every month, they pay every quarter. So the math gets a little bit different, but here we go. We get an additional 4.5 shares of SCHD, followed by 2.53 shares, and then 4.07. Then we get a dividend. And that dividend is 54 cents per share, and 11.10 shares is what you racked up in those last 3 months, which means you're getting a total of $5.99. But let's get right to the bottom line. So what we're going to do now in the case of SCHD is with the waterfall method, during our time period, you racked up a total of 106.09 shares of SCHD, which with their annual dividend payout amount, that is a total of $2.39 per share. That means you got a total of $253.55 in income as a result of waterfalling into SCHD. But what happens if you would have just did a dividend reinvestment plan with your 500 shares of JEPI. By reinvesting back into JEPI, that would be 128.71 shares, and they currently pay a total, according to the dividend tracker, of $493, which means that you would have earned an additional $634.54. Now, do you see the big difference? Unlike O versus JEPI, when we look at it this way, the waterfall method is a bad idea. DRIP would have been better. You would have made an additional $634 more versus SCHD. Now that's if and only if you're only focused on the dividends. Now, if your goal is, I would love to play with house money, which means I got my shares of JEPI, and it doesn't matter if it's 1 share or 500 shares, doesn't really matter, but you're taking your dividends because you want to buy SCHD and you just want to play with house money, aka dividends, aka not your actual job income to buy more SCHD. You truly want to just build an investment based on your investments, well, then this would be fine. But just keep in mind, your overall dividend rate will be lower, but the hope would be SCHD will outperform JEPI over the long term. So the first thing you want to look at is, what are your dividend yield percentages? If you're going to do something with the waterfall method and you're attracted to continuing to grow your dividend amount, what you need to think about is, could I start with maybe a lower dividend rate, scale up in waterfall to a higher dividend rate, and then maybe even take that to a third step to an even higher dividend rate? We're talking like you could do something really small, like an Apple, which only pays like 0.6% or whatever it is on the dividend rate, and then take those dividends and waterfall them up to maybe like, I don't know, SCHD, and maybe take the SCHD dividends and waterfall them up to JEPI. That would be interesting. But let's look at the total return of all three of these that we looked at in today's video, JEPI, O, and SCHD. I mentioned just a second ago that ideally, even if you want to waterfall into SCHD, the goal with SCHD is you're going to see growth. You're going to see growth plus the dividends. JEPI, you're going to see some growth, but theoretically SCHD should outperform. So they're all negative because in the last year we had, let's be honest, a little bit of a recession in 2022. But if we look here, SCHD down at 2.85%, and then you have O down at 11%. Whoa! But of course, keep in mind with the pandemic and all the other things, O did take a beating, and that's to be expected. And JEPI not down as much as, SCHD, but it's down a little bit. But let's scale this up to the 3-year. Now have a look. Which one's outperforming? SCHD, indicated by the purple line on this graph. And that's the biggest difference, And then the underperformer, surprisingly, is JEPI in comparison to O. And it's another reason why I have used SCHD as part of my overall dividend and FIRE portfolio. And I'd love to tell you more about it. Check out this video next on SCHD and why I'm all in on this particular fund. We'll see you on the next video.